Welcome to The Explainer. You know, everyone wants to know the secret to building real, long-lasting wealth. Well, today, we're going straight to the source. We are cracking open the 1988 playbook from one of the greatest investors in history, Warren Buffett, and we're going to use his own words to see how he did it.
Just look at this number. From 1965 all the way to 1988, Berkshire Hathaway's book value grew at an absolutely astounding 23% a year. To give you some perspective, that means he was consistently doubling its value every 3 or 4 years. It's a compounding track record that's, well, it's pretty much legendary in the world of finance.
So, the big question is, how on earth did he pull this off? Well, the answer isn't some complex, secret formula. It's actually a powerful and surprisingly simple philosophy that flew right in the face of what everyone on Wall Street was doing. Let's really dig into what that looks like. All right, so here's how we're going to break it all down. We're going to look at 4 core principles from this incredible letter. First, why you should buy wonderful businesses. Second, why you need to think like a business owner. Third, how to beat the so-called efficient market. And finally, what your absolute favorite holding period should be.
Okay, first things first. For Buffett, it all starts with buying exceptional businesses run by exceptional people. He's not interested in stock tickers and fancy charts. He's buying into real companies that he understands, run by management that he actually trusts.
I mean, listen to this. He truly believes in great management, and he values real-world experience and integrity way more than a fancy degree or just being young. And what's so interesting is this idea guided everything. He wasn't looking for companies to take over and change. He was looking for amazing managers to partner with, and then he'd just get out of their way.
In 1980, he talked about this group of companies he called the Sainted Seven. And as you can see, these were not glamorous, high-flying tech companies. We're talking candy, uniforms, vacuums, but they all had something special, a really durable competitive advantage. And get this, together they earned an incredible 67% on their equity capital, all without any debt.
And the managers themselves, they were absolute legends. Take Rose Blumkin. Everyone called her Mrs. B. She started the Nebraska Furniture Mart with just $500. By 1988, at 95 years old, she was still running this retail empire she'd built from scratch. Her philosophy was just that simple. For Buffett, this was the ultimate proof that great character and a simple, honest business model are what really create lasting value. And this focus on real-world business, not just the numbers on a page, leads us perfectly into his next big principle.
So Buffett's second principle is a huge warning. Standard accounting rules, GAAP, they don't always give you the full picture of a business. To really see what's going on, you have to stop thinking like a stock picker and start thinking like you own the entire company. He pointed out that accounting can be used to create what he called an economic illusion. Some managers can use the rules to paint this beautiful, rosy picture that has almost nothing to do with reality. So, if you're a smart investor, you have to look past that and see the true picture.
And this really shows you the difference. He says instead of just accepting the numbers you're given, a real owner digs deeper and asks 3 key questions. What is this company really worth? Can it actually pay its bills down the road? And how good is this management team really? These are the kinds of questions that accounting alone just can't answer for you. Now, back in the 1980s, there was this very popular theory in academia that said it was impossible to consistently beat the stock market because all the information was already baked into the stock price. Well, Buffett used his 1988 letter to show everyone just how wrong that was. This theory, called the efficient market theory, basically said you could pick a portfolio by throwing darts at a newspaper's stock page and do just as well as some expert analyst. And Buffett, well, he thought that was complete nonsense. He loved telling stories like this one about a quirky cocoa bean arbitrage from early in his career. It shows the market is not always rational. Basically, a chocolate company had a ton of cocoa beans that were suddenly worth way more than they were on the books. But if they sold them, they'd face a huge tax bill. So they found a loophole and offered to trade the beans for their own stock. A young Buffett saw this, bought the stock, immediately traded it for the much more valuable cocoa beans, and made a nearly risk-free profit while everyone else missed it.
And here's why that kind of thinking matters so much. Over 63 years, a standard 10% market return would have turned $1,000 into about $400,000. Not bad, right? But the 20% return you could get from this kind of analytical, independent thinking, that would have turned $1,000 into a mind-blowing $97 million.
And all of this leads right into his final and probably his most famous principle from that 1988 letter. There it is. This is really the core of his entire philosophy. If you've done all the hard work to find a wonderful business run by wonderful people, the goal isn't to flip it for a quick profit. The goal is to own it and let that business compound its value year after year for decades.
He contrasted his approach with a really common mistake people make. They sell their winners way too early to lock in a profit, but then they stubbornly hold on to their losers, just hoping they'll turn around. He had a great way of putting it. It's like cutting your flowers and watering your weeds.
So when you put it all together, the Buffett playbook is this really clear, powerful set of rules. It's about buying quality companies with great people, thinking like an owner for the long haul, and most importantly, just having the guts to think for yourself. It's a philosophy that's just as powerful today as it was back in 1988. You know, this 1988 letter, it's so much more than a financial document. It's a masterclass in a whole way of thinking. And it leaves every single one of us with a powerful question to ask ourselves. Are you just picking stocks? Or are you becoming a true long-term partner in a wonderful business? Because the answer could change everything.